This is the second video in the series, Enjoying Your Financial Journey. In the previous video, you understood where you stand and your approach to financial investments. Now let's look at some practices that can make you a good investor. First, developing fundamental conviction. Developing fundamental conviction is about understanding the foundational principles or crux of the matter and separate it from the fringe elements such as marketing, storylines or biases, emotions, etc. Fundamental conviction on any topic, including financial products, can be developed through a cycle of learning, mental models and judgment. Learning includes, first, reading or viewing quality content on the subject, which leads to vicarious learning, that is learning from mistakes of others. Second, small hands-on attempts on the area of interest, which essentially serves as a sneak peek and a practical on the area in focus. Third, multidisciplinary learning, which means learning multiple disciplines to expand cross-learnings across different domains. Learning builds mental models, which acts as references or guides for our decision making. Mental models, in turn, enables better judgment as an investor. Judgment removes noises from the inputs we feed into the learning process. Noises include marketing content from mutual fund companies, banks, brokers, etc. Prophecies and super return claims from many experts on the web, financial blogs, vlogs, etc. Research articles and buy-sell recommendations, news articles, financial advice from friends, acquaintances, gossips about friends in our circle making super financial returns, webinars, sessions, interviews, panel discussions, and so on. Noise is more complicated when it's a mashup of these across various channels such as SMS, phone calls, emails, social media, messengers, groups, pop-ups, ads, and so on. Removing noise increases the learning efficiency, completing the overall loop. Ideally, you should invest only in products where you have high fundamental conviction. For example, to develop fundamental conviction in crypto coins or say crypto NFT, you should learn blockchain technology. Without fundamentals, we'll just be in speculating mode. Second practice, resisting temptations and emotions by seeing the big picture. Very often, temptations and emotional reactions blind our ability to see big picture and land us in trouble. While the ability to see big picture comes with experience, certain obvious pitfalls to watch out include transactions due to the fear of missing out, monitoring unrealized gain or loss too frequently, intensive effort to time the market perfectly, pondering over the penny difference in transaction price with that of a friend, translating market decline to a sell action. Now, what is the corresponding big picture for all of these temptations or emotions that we face? The fear of missing out can be eliminated by seeing the big picture that majority is not always the right choice. On the unrealized gain or loss, remember that it's just on paper and not on the bank account. And regarding timing the market, we should understand that no one can time the market accurately. Only approximation or guidance possibilities exist. And regarding this pondering on the penny difference in transaction price, you should stop comparison. Minor differences don't matter too much in the long term. And regarding selling your portfolio during a market decline, understand that market decline is a time to buy quality products. Resisting temptations to act and seeing the big picture adds to compounding your wealth in the long term. For example, how many friends do you have who have completely abandoned equity markets due to a loss in the past? Did they fail to see the big picture? Now the third practice, building loss cushion. Loss cushion refers to the shock absorber that can absorb or minimize the impact of the disturbances in our financial journey. Building loss cushion gives us resilience to bounce back from unexpected setbacks. Losses are a part of the game, but minimizing its impact is crucial to ensure that you take learnings from those events and speed forward. Two stages to build loss cushion include transaction planning and setting aside provisions. Transaction planning stage include diversification of investments, margin of safety in fixing the purchase price, and spreading investments across time buckets. All these steps ensure that the damage from any specific event is minimal. Now coming to setting aside provisions, it refers to keeping a small percentage of the planned investment to build a buffer amount. This essentially becomes our shock absorber. The percentage of provisions should be as per the perceived risk of your investment. Contingency fund that we discussed in our budgeting video is one of the basic versions of this loss cushion. Now the fourth practice, setting realistic return expectations. Are you familiar with these punchlines? 5 multi-bagger stocks to buy in 2021. Multiply your money through our recommendations. This crypto coin has grown more than any other instrument in history. What do all these claims have in common? It's a mix of storytelling, bogus claims, mis-selling attempts, or even scams to shift your reference point and to fire our money ambitions. Setting the right mindset is important for us to be able to judiciously take calls in a very dynamic and many a times confusing market. Be aware that there are many instances where we make multiplier gains from our investments, but setting that as a norm or expectation at the beginning of the investment journey is dangerous. On this framework for setting realistic return expectations, at the base end of the spectrum we have capital protection, which, say for example, is like keeping your money in a savings bank account. The capital is guaranteed, it doesn't go anywhere. Second, inflation beating returns, for example, an FD or an RD. Then you have loan beating returns. Remember that loan rate of interest always will be above inflation as banks want to make real returns. For example, debt mutual funds. Then you have the business returns category. There we have the equity mutual funds, stocks, etc. And then on the right extreme, you have the multi-bagger returns. Say the latest trends like Bitcoin, Ether, etc. In this framework, as we go left, capital protection is the priority. And as we go right, returns take the top seat. So as we go right, especially for investments that claim to be multi-bagger, it will most probably be a very dangerous zone that warrants deep study before making the move. Ideal would be to mix your portfolio across these ranges to get a mix of returns and capital protection. If someone is inviting you to the dangerous zone, study it carefully before jumping in. Remember, there is no free lunch. To conclude, we have seen 4 best practices that can help you become a good investor. First, developing fundamental conviction. Second, resisting temptations and emotions by seeing the big picture. Third, building loss cushion. And fourth, setting realistic return expectations. This is just a starting point. There could be many more that you may develop in your financial journey. Do comment and let us know.